You saw the prices drop, you felt your stomach drop with them. And then a voice in your head said, "This is it. This is the dip. Buy it now before it bounces back without you." That feeling is one of the most powerful forces in all of investing, and it has cost more people more money than almost any other impulse in the market. Today, we are going to talk about buying the dip. Not whether it works in theory, it does in theory. We are going to talk about the part nobody warns you about, the part that separates the investors who profit from pullbacks and the investors who get destroyed by them. Because those two groups often make the exact same trade. They just happen to be in very different situations without knowing it. Let's start with why the idea is so appealing. Buying the dip is just buy low, sell high, the oldest rule in the book. When an asset you believe in falls in price, buying more of it at a lower cost seems like pure logic. You are getting the same thing for less money. If your thesis is right and the price eventually recovers, you come out ahead. The math is undeniable. The problem is never the math. The problem is the assumption hiding inside the phrase itself. When you say buy the dip, you are already assuming something enormous. You are assuming the decline is temporary. You are assuming the longer-term story is still intact. And here is the brutal truth. In the early days of a price drop, you almost never know if that assumption is correct. This is the core tension. A dip and a structural decline look identical in the first few days, sometimes in the first few weeks. A dip is a short, sentiment-driven pullback. Prices fall not because anything fundamental has changed, but because investors got scared, or profit-taking kicked in, or the broader market dragged everything down with it. Those dips do recover. History is full of them, but a structural decline is a different animal entirely. A structural decline happens when the underlying story actually changes, when a business model breaks, when a macro shift rewires an entire sector, when credit dries up, and the assumptions that justified the valuation no longer hold. Structural declines do not bounce back on the same timeline. Sometimes they do not bounce back at all, at least not to where they started. And here is the part that should keep you up at night. Traders have a name for what happens when you buy into a structural decline, thinking it is a dip. They call it catching a falling knife. The knife is still moving. You reach for it anyway, and the results are exactly what you would expect. So the real question is never, is now a good time to buy the dip? The real question is this a dip, or is this a change story? To answer that, you have to go back to why you bought in the first place. What was your original thesis? What did you believe about this asset, this company, this technology, this sector? Now ask yourself honestly, has any of that changed? Not the price, not the chart. The actual underlying reason you believed this was worth owning. If the thesis is intact and the price is lower, that is a compelling argument for adding to your position. If the thesis has cracks, if the thing that was supposed to happen is not happening, if the competition got stronger, if the regulatory environment shifted, if the numbers stopped making sense, then a falling price is not an opportunity. It is information. It is the market telling you something you may not want to hear. Now here is the second problem. Even when you get the thesis right, timing still matters for your portfolio health. Being right about the long term and being early are not the same thing. If you buy too soon in a prolonged drawdown, you tie up capital at a moment when better opportunities might emerge. More importantly, you test your own psychology. Watching a position go further against you, even when you still believe in it, is one of the hardest experiences in investing. That pressure causes people to sell at exactly the wrong time. They hold through the drop, absorb the pain, and then give up right before the recovery. That is the sequence that permanently damages portfolios. This is exactly why systematic investors argue against trying to call the bottom at all. Dollar-cost averaging is the strategy of buying a fixed amount on a regular schedule, regardless of price. Not because it maximizes returns in a perfect world, but because we do not live in a perfect world. We live in a world where emotions are real and conviction wavers under pressure. Spreading your purchases over time, removes the need to be right about the moment. You will buy some shares higher than you would have liked. You will buy some lower. The average cost smooths out. And more importantly, your conviction stays intact because you never went all in on a single bet. The insight behind dollar cost averaging is not technical. It is behavioral. The difficulty in buying the dip is not knowing that markets recover. The difficulty is holding your position while the recovery is still invisible. So here is where we land. If you are watching prices fall right now and your hands are hovering over the buy button, do not ask yourself when to buy. Ask yourself why you believe. Go back to the thesis. Pressure test it against what is actually happening. If it holds up, size into a position you can live with, not one that keeps you awake staring at charts at 2 in the morning. And if the thesis has genuinely changed, the fact that prices are lower does not make it a bargain. It makes it cheaper than it was. That is not the same thing. The market will always give you another dip. What it will not give you is another chance to protect the capital you lost catching a knife on the way down.